Hi, I'm Brad, Certified Financial Planner, and today I'm with Matt Callahan, and we're going to be talking about the 4% rule. What is it? Is it still effective? And we're also going to talk about strategies to ensure that you don't run out of money in retirement. So Matt, we work with a lot of retirees and people who are either in retirement or about to transition into retirement, and it seems like the top thing on their mind is just making sure that they don't run out of money. And there's this thing out there called the 4% rule. It's got a lot of energy around it on the internet. What is the 4% rule? How do you think about it? How do you apply it to your clients?
That's a great question. So the 4% rule is something that was derived a number of years ago, got put into place, and they're saying that you can safely withdraw out of any 30-year time period 4% from your portfolio.
Okay.
So if you had $1 million in your liquid net worth, you could safely pull out $40,000 per year.
Okay.
And so that would be in addition, so your Social Security benefit if you have pensions or real estate income coming in as well. And so the reasoning behind it is you're hoping to get 6 to 8% in your portfolio over time. Let's just look at 6%. If you're only pulling out 4% of your portfolio and you're making 6%, you're still keeping up with inflation and keeping your purchasing power strong.
Okay, so how does it work? You mentioned someone has $1 million, they can take 40,000 out in year one. Mm-hmm. What happens? Is it 40,000 for the rest of retirement, or how does it work?
It depends on that. Some people will say just pull out 4% of your starting value each year. We lean more on the conservative side, and you may want to look at your value of your portfolio each year. So if the portfolio goes up, you pull out 4%. You could be giving yourself a higher paycheck that year. If it goes down, then you'll take out less. So you just need to be aware every year looking at that.
Yeah, I mean, this Bill Bengen was the guy that did the study. Came out in '94, and it was wild. He looked at 50 years of data, and he looked at what was the optimal withdrawal rate to make sure that someone didn't run out of money in retirement. Mm-hmm. And he came up with 4%. I think he had something like 50% in stocks, 50% in bonds. I'll ask you about that later. So with this 4%, is it? So in other words, what I'm hearing you say is it's dynamic in nature. How often should you revisit this thing? I
would really think if you're looking at distribution strategies, it should be an every year thing. You want to be safe, and especially a lot of people like you out there don't want to run out of money, so it's very important to review your distribution strategy each year.
And does it matter what month or time of the year, or does that not make a difference?
Maybe end of the year, beginning of the year, so you can just have the value for going into that next year of what your portfolio looks like.
Okay. So what happens if there's someone out there and they're thinking, I want to take more than my 4%? Is it just a hard fast 4, that's it, or can they take more? How does this work?
I would say that you could look at the portfolio and decide based on your plan, how long is the longevity you're looking at in your plan. You'd mentioned a 50% stock, 50% bond portfolio. Just a reference point, 60% stock, 40% bond is an average retirees portfolio. Mm-hmm. And I believe it was 50-50 or 60-40 where that 4% rule came out of.
50-50.
Okay, so if you're in a more aggressive portfolio, let's say 80% stock, 20% bond, you may be able to pull out more than 4%, but just know that the volatility is going to come along with that, so the ups and downs in the market.
Oh, okay, so there's 2 questions I want to ask you. I'll try to remember both here. You talk about a more aggressive mix, experiencing more volatility. Talk to us about this thing known as the sequence of return risk. What is that? How does that apply to this conversation?
So your early years in your retirement, what sequence of returns risk is that if the markets are down when you're transitioning into retirement and then you're taking distributions, it can really put a huge hit on the portfolio or put a lot of stress on it. So markets are going down, portfolio's down, and you're still taking out the same amount. You can look at a chart, and maybe we can show on the screen or in the comments that if you have the same rate of return average over a long period of time and you start off your retirement with positive years, you can extend the value of your portfolio. But if you flip-flop the same rates of return and they're negative in your first years of retirement, you can deplete it quicker. So it's something definitely to be concerned about.
I know what you're talking about. It's the one where you got 2 investors in retirement and they both have the same average, but the path or the journey of how they got that average can be totally different. Like you said, if there's negative returns early in retirement, even though they may get the same long-term average, that person may run out of money.
And so to piggyback on just your retirement distribution strategies, if you are transitioning into retirement, it may make sense to work one year longer. I know we don't want to when we get to the 1 yard line of retirement, but that 1 year can actually buy you 2 years in retirement.
What do you mean by it? How do you mean?
So what I mean is that it's 1 year less year of you having to dip into your portfolio, and 1 year of maybe being able to make contributions to your investment accounts.
Okay.
And so that can help. And worst case, if you're through, you're done with retirement, and you're just like, I'm done, I still need to take distributions. Hopefully you have the ace up your sleeves of Social Security. Of course, we'd want to delay that as long as possible, but if you have to turn that on just to get through the market downturns, that could be a way through.
Well, I'm glad you brought that up, because there's a lot of energy on the internet about when should you take your benefit. I mean, how do you think about Social Security, and then how do you think about other sources of income in retirement in the context of your client's retirement plan?
So a lot of things going on there. What we call this is a flooring strategy. So all the income sources that you have that are coming into the door, no matter what's happening in the market. So depending on your plan, the strategy may be 50% floor up to 80, depending on where you're at and how much income you want to come in, no matter what's happening in the market.
So this is something that retirees ask. I know they ask both of us all the time. They say, okay, what if they are delaying their Social Security till, say, 70 when it maxes out, but they don't want to work until 70? Can someone take out more than 4%? Let's say they want to retire at 65 or 66. Can they take out more than 4% in the beginning, and then when Social Security, as it's grown larger, let's say they take it, they delay it, then can they reduce that IRA distribution or the retirement distribution? How does that work?
Yeah, absolutely. And we see this all the time. And be surprised or not, but people get, not awkward, that's the wrong word, but they get a weird sense when they're having to take more out of their portfolio or their nest egg at the beginning. But we just help and coach them that with Social Security, every month that they're waiting after their full retirement age, so typically 67 if they were born 1960 or later, they're getting a 2/3% guaranteed interest. And we don't say the G word around here, but the guaranteed interest from your Social Security benefit turns out to be 8% over the year. And so we would hope that our investments get 8%, but you have to go with the ups and downs of the market. So maybe, tapping in a little bit more out of that investment portfolio to let that guaranteed growth work over time.
So in other words, what you're saying is you're taking a little more out of your investments. Meanwhile, your Social Security is growing at a guaranteed 8%. So if you delay 3 or 4 years, that's 24 to 32% larger.
Absolutely.
Okay, so then what happens? The person that delays, then would you reduce your retirement distribution down?
Yeah, so when they delay, they start turning on the spigot of Social Security, then we can reduce those IRA or Roth IRA distributions in the future.
So kind of something you said earlier, I mean, this sounds like it's a very dynamic process. It's not just sort of turnkey, set it and forget it and come back 20 years later. It seems like it's very dynamic.
Absolutely. A lot of moving parts. I mean, you're looking at your financial plan, your goals that you want to accomplish early in retirement versus late in retirement. Do you have a long life expectancy? Does spouse have short life expectancy? You have long life expectancy? I mean, it really depends on what you're trying to accomplish.
How much you want to spend.
Yeah. How much do you want to, what do the vacations look like?
That's right. Yeah. Are we camping or are we going to the Ritz-Carlton?
Yeah.
Yeah, right. It makes me think of something, the spending smile, the retirement smile, where if you think about a smile, you think about the go-go years when you first retire. You're excited, you're ramped up, you want to travel, you want to get out there and go. And then the slow go years, maybe it's in your 70s, late 70s, early 80s, where you're slowing down a little bit, you're not as active. And then the no-go years where you're really not traveling a lot, and that spending smile, you spend a lot in the beginning because you're having fun doing all the things you want to. You start to slow down for a period of time there, but then the spending ramps back up on the back end because medical, long-term care, needing assistance, that sort of thing. So I guess having a portfolio that can keep up with that is important. Yeah,
it's really, really good to just have it designed to accomplish your short-term goals and your long-term goals and rebalancing through those ups and downs. But more often than not, we are having to coach clients to spend more money up front. And maybe it's above that 4% rule. It's just a general guideline, but it's like, hey, we know we can spend a little more because Social Security turning on in the future is going to put a lot less stress on that portfolio.
Well, speaking of stress, are there ways to stress test the results here? How do you present this to clients?
Yeah, so there's a Monte Carlo simulation. It basically takes the client's plan through 1,000 randomly generated market scenarios. You know, some really good years, some really bad years, and everything in between. And we just want to make sure that no matter what the markets are doing, what we can't control, whatever they get thrown their way, that their plan still works.
Okay, so I want to go back to something you touched on earlier. So Bengen, when he did this study that came out in '94, and he didn't actually coin it the 4% rule that everybody else did, but he looked at a 50-50 mix, stocks and bonds, and he had long-term stocks doing something just slightly north of 10% per year, while he had bonds doing about 5.3% per year. Interest rates since '94 have done nothing but come down until recently. So bond returns have been a lot less than the 5.3. So I guess a couple questions. What's the optimal asset allocation for someone to take into retirement? And does the 4% rule work? Does it still work anymore?
That's an interesting question. So I would say you need, just like you said, the interest rates have not been where they were. You know, they just started coming back. We're finally getting some interest back on accounts. But what we saw the last couple of years is, remember we talked about that 60-40 portfolio being the typical retiree's portfolio?
Yeah.
Well, we were seeing that people had to take a little bit more risk. So maybe going up to 70% stock, 30% bonds to get the same return they used to get in the 60-40. So having to take more risk to get less return. So again, I would lean on, look at your plan. Does the 4% rule work? Yeah, in general, but you have to look at your specific plan and needs.
So it's almost like 70-30 might be the new 60-40.
It could be, yeah.
Well, that leads to, there's a lot of things out there about the 60-40 rule being dead. Is the 60-40 portfolio dead? What are your thoughts on that?
It's a tough question. So I would say that it's not dead. I mean, we've seen interest rates starting to come up. I think the 10-year Treasury is around 4.6%. This is a real good indicator for a couple of things. One, investor confidence over the next 10 years, and then what we expect the bond portfolio to do over the next 10 years. So if we got 4.6 coming in from our bond portfolio, we would hope, we know risk and return are related, that your equity or stock portfolio would do better than that.
Right, and it's so interesting too, there's so much out there about, the 60-40 portfolio is dead. That happened in 2022 where it was really an anomaly where both stocks and bonds went down in the same year. But it was almost like it needed to happen because we had been in this 30-year environment where interest rates had trended down, which meant that bond prices had trended. So bonds had a 30-year run that was really good there. And it was almost like 2022 was the resetting of that. The Fed had to increase rates rapidly, and so the bond market went into turmoil. And so it was a rough year for bonds. Last year bounced back. Bonds did fantastic. This year it's choppy again because the interest rates are fluctuating. But it's almost like on the go forward, kind of backing up what you're saying, that the 60-40 portfolio seems to be alive and well. In fact, it did quite well last year.
Well, we all got comfortable with markets just going up and up and up over the last 10 years. And when they finally do what markets do and go down into bear market territory, that we freak out and think that the market doesn't work anymore. But really, now we're starting to go into a more normal market cycle.
Yeah, it's our behavior to the way markets work that's really broken, not the markets. And so that leads to another great question here I want to ask you about. So Bill Bengen in his 4% rule says 50-50. You've talked about 60-40 as a more traditional allocation. Maybe 70-30 is the new 60-40. So somewhere in that range. We certainly don't want to be too conservative or too aggressive. But once we settle on the optimum asset allocation, how do we manage that allocation throughout retirement? Is it like set it and forget it? or how do you do it?
I wouldn't say it's set it and forget it. I would say if goals and objectives have changed, that's when you want to make drastic changes to the portfolio. We're in an election year this year. Just because something's happening in November, we don't want to make tweaks to what we think is going to happen in the world. But if your goals and values have stayed the same, you want to just rebalance through the market turmoil. So it'll be more volatile. I'm not saying that, but you should have a number of different asset classes in your portfolio.
Okay.
Some do well when others don't do well, and you can sell the winner to buy the loser. And you're probably thinking, well, that's crazy. Let's let that winner ride, right? Well, no, we're buying low and selling high in real time.
Which we all should do.
Right.
But no, have you ever seen anybody do it very well themselves?
No, we wouldn't be sitting here and everyone would be on their yachts having a great time right now.
Yeah, and I think you're onto it. It's you own something that's done well, it feels good, and you're thinking, well, I got to sell a little bit of the thing that's done so well to buy the thing that's been a dog for 3, 5, maybe 10 years. Mm-hmm. You know, it comes to mind in 2009 when the S&P 500 had just finished a 10-year run. It lost 1% per year for 10 years. And I had people asking me in 2009, we're going to sell the S&P, right? It's a loser. In fact, this emerging market's red hot. Let's buy the emerging markets, international small cap, US REITs. But anything but the S&P, it's just really been terrible. And I said, no, you cannot sell this thing. Not because I could forecast the future. I mean, my crystal ball broke years ago, but it's simply because these things ebb and flow. Mm-hmm. So now you look back to 2009 and the S&P 500's been on the run of all runs. I think it's compounded at 12, 13% over the last 10 to 12 years.
So is it time to chase that shiny object?
Oh, I mean, sell the international because it hasn't been as good? No, not because my crystal ball works. I'm telling you, it's broken, but these things ebb and flow. So walk us through how this would have worked here. In the last 10 years, the S&P 500 has been red hot. It's been the big winner. How would the rebalancing work of each year, and should you rebalance quarterly, annually, how does that work?
At a minimum, I would say rebalance your portfolio once a year. Pick a date on the calendar and just go rebalance at that moment with whatever percentages you choose for your asset allocation. But with technology, it's fantastic. It allows us to put parameters on our different asset classes. And so we have a 2% drift on each one of the asset classes. So we go in there and actually rebalance in real time.
So as soon as anything represents too much of the portfolio because it's done, well, you just do it immediately.
Right. And yeah, we like international, but we do have a home-based bias. So we're tilting towards more U.S. stocks, but we still have a balanced portfolio with U.S. and international.
Okay. So a couple takeaways, and it sounds like the 4% rule works. And depending on someone's plan, maybe they can take out more, but kind of a 4% at a minimum there. It's not static, it's very dynamic. This thing needs to be evaluated constantly. Mm-hmm. And it sounds like the 60-40 portfolio is not dead, but somewhere in that range, 50-50, 70-30 kind of seems, depending on the plan, like it could get the job done. Anything else to add on this?
Yeah, I think you nailed it there. You have to review this every year at a minimum. I mean, people, they get a financial plan in place a lot of the times and then they just throw it on the shelf and don't implement new strategies. Right. Well, it's a living thing that we like to say. And so basically when you walk out the door, your plan's going to change and you just need to keep up with what works for your plan.
Yeah, great. Well, thank you.
Yeah.
All right, well, hope this was helpful. Tested in the trenches, real world anecdotes from this is what we do every single day. We help people make these decisions and navigate retirement. So thanks for your time, Matt.
Yeah, definitely.
All right, see you next time. If you enjoyed this content, make sure to share it with friends and family who you think can benefit from it. We'll see you next time.